Well, mutual funds in general, and I can go into more specific on the bond side, but just say mutual funds in general. And as you alluded to, we do both. So I don't have any axe to grind. I don't have any any bias because we do both. But the reality is that the mutual funds, as is implied by their name, they're mutual investing of many people. So you are collectively putting your money together mutually to invest. All right. Well, if you think about that for a minute, why are you going to collectively put your money together with other people to mutually invest versus doing it on your own? Well, the reason is that you don't have enough money. So the whole mutual fund industry and mutual funds in general were really designed so if you didn't have enough money to either go into an investment or more specifically, usually you didn't have enough money to diversify. So to say you really should have anywhere 30, 40, 50 stocks in the portfolio, you just didn't have enough money to diversify that much on your own based upon typical trading parameters. So they said, oh, well, let's put you together with another small investor and you together with another small investor. Now we'll have 1,000 small investors. And together, as a team, we can diversify. Okay, well, there's several things with that. Number one, you're doing it because you don't have enough money. So guess what? Once you have enough money, you don't need to do that anymore. So we have it. It works because we have smaller investors. And so it works very good for them because now they can get the 35, 40 different securities that they can't get on their own and get diversification. Now, once someone is large enough, and we generally look at that in most cases, depending on the investment, it tends to be 100,000 to 250,000. At that point, we can really get all the diversification that we want in that portfolio for that client individually. So there's no downside whatsoever. They're going to get all the diversification. There's no downside. There's no negatives now. And now there's only, frankly, positives. Because normally what you have is by doing an individual portfolio, now it's customized. You're not just in with another 1,000 people or whatever. It's customized to your specific investment objectives. You can somewhat customize the timing of when you're getting in. Because if you go into a mutual fund, you're all in, you're all out. All right, nobody's taking your extra 20,000 and then going out structuring a new portfolio. You are buying the existing securities that are there. Some are up, some are down. Some they may sell tomorrow, and you're buying it and they're selling it tomorrow, and you're taking a capital gain on it because it's based upon the cost they bought it in the portfolio, not your cost. So you're taking a capital gain, and you didn't even get any of the gain, and because it's not customized. So by going separate at that point, once you're at that level, depending on strategy, like 100 or 250,000, well, now it's starting from scratch for you. It's being built for you. It's going to be a completely custom situation. And one of the biggest things is that now as you add money or take money out, you can go and a portfolio manager can distinctly say, you've got 250,000, you need to take out 30 for a new car. Well, we can go pick and choose what we're going to take out. It's not sell everything or part of everything. We can pick and choose what we're going to sell. When you put another 30,000 back in, we can pick and choose how we're going to deploy it. It just doesn't all get invested that day. And so it's, again, we can customize it. And frankly, one of the biggest additives and biggest benefits to add additional return is, especially for taxable clients, is that you have the chance to do tax planning at the end of the year. So look, the consequence of being in the securities markets is hopefully you're going to have gains. I mean, that's why you're there. So when you have gains, you're going to have stocks that run up, and they run up to a certain level. We feel they've hit our profit targets. We're going to sell it and move on to something else, or sometimes we may sell half of it. Well, when that happens, then you have a taxable event. You have a gain. You're going to pay, not including state tax, you're going to generally pay somewhere 10 to 20% tax on that gain. All right, well, if you're in a mutual fund, that's just it. You're done. Nothing you can do. In a separate account, we can say, all right, looking at it at the end of the year, you've had $30,000 worth of realized gains. So you would have to pay, again, somewhere between 10 to 20% of that in tax. But we can look at it and say, well, wait a minute, this other stock didn't do so well. All right, so it's down about 10,000. And what we can do, we still like it, even though it's down, but we can sell it, take the $10,000 loss, subtract that from your $30,000 gain, so now you reduced your taxes by 30% down to $20,000 gain. And then we can turn around 30 days later after what's called the wash rule and reinvest back again into that stock that was down. So you basically took the loss was offset against your gain, you lowered your tax bill, you still went back into the same strategy, and you're right back where you were, but you saved a bunch in taxes. And so that's something where a separate account distinctly and overwhelmingly is so much more tax efficient. And we have to remember, hey, it's not what you make, it's what you keep. So that's a very important aspect.